1.9 billion euros vanished. The money never existed. And the regulator whose job was to prevent this had been busy prosecuting journalists. This is the Wikipedia entry for the Wirecard scandal, updated through mid-2026. It documents the largest accounting fraud in German post-war history. But buried in the middle of this page is a structural detail that explains everything. Germany's top financial watchdog, BaFin, lacked the legal authority to investigate Wirecard's core business. It could only oversee the company's small banking subsidiary. So when critics raised alarms, BaFin did the only thing it could do within its mandate. It went after the critics. Wirecard processed payments, credit cards, debit cards, online transactions. By 2018, the company had grown valuable enough to replace Commerzbank in the DAX, Germany's index of its 30 largest public companies. The market valued Wirecard at roughly 24 billion euros at its peak. SoftBank injected 900 million euros in 2019. This was a national champion, proof that German technology could compete with American fintech. Tens of thousands of retail investors held the stock. Pension funds held it. And then, in June 2020, it all collapsed in less than a week. To understand how Wirecard worked, you need to understand what payment processors actually do. When a customer swipes a card, money flows from their bank to the merchant's bank. The processor sits in the middle, routing the transaction, taking a small fee. Wirecard claimed to process enormous volumes across Asia, the Middle East, and Europe. But much of this volume allegedly ran through what the company called third-party acquirers. These were local companies in places like the Philippines and Dubai that supposedly processed transactions on Wirecard's behalf. Here is where the structure became unusual. According to internal whistleblowers cited in this document, transactions from third-party acquirers accounted for half of Wirecard's global transaction volume by 2018. The cash held in trustee accounts at these third parties was counted directly on Wirecard's balance sheet. And critically, almost all of the company's profit came from just 3 of these opaque partners. Wirecard's auditor was Ernst & Young. EY had been auditing the company since 2007, when it conducted a special audit in response to early criticism and then took over as the primary auditor. For over a decade, EY signed off on financial statements that included this third-party cash. But as later revealed by a KPMG special audit, EY failed to verify the existence of these cash reserves. The verification documents appeared to be fraudulent bank statements. The first serious external crack appeared in 2015. The Financial Times reported what it saw as a significant gap between short-term assets and liabilities in Wirecard's payment business. Wirecard responded by hiring a UK law firm and a public relations agency. That same year, a research firm called J Capital recommended shorting the stock, arguing that Asian operations were much smaller than claimed. In 2016, an anonymous report from something called Zatara Research caused the share price to crash. BaFin's response was to launch an investigation into possible market manipulation by the short sellers. This pattern repeated. In January 2019, the Financial Times reported that Wirecard's head of accounting for Asia-Pacific operations had allegedly created forged and backdated contracts to inflate profit. A preliminary report from an external law firm pointed to years of book padding across Asian operations. Singaporean authorities raided Wirecard offices, and BaFin's response was to ban short selling of Wirecard stock for 2 months. The document states explicitly that BaFin lacked authority over Wirecard's core business. It could regulate only the banking subsidiary, Wirecard Bank AG, the payment processing operations, the third-party acquirers, the Asian expansion. All of it sat outside BaFin's jurisdiction. So when journalists published damaging reports, BaFin's investigators filed complaints against the journalists. German prosecutors investigated an FT reporter for alleged market manipulation. Wirecard went further. According to this document, in 2019, the company hired a former head of Libyan foreign intelligence to conduct sting operations against journalists and short sellers. A private detective named Avira Mazzari, later convicted in the United States for hacking schemes, had targeted companies critical of Wirecard. The company did not merely deny allegations, it attacked anyone who made them. Sell-side analysts remained almost universally positive until February 2020. Goldman Sachs maintained a conviction buy rating until September 2019. Commerzbank analysts dismissed Financial Times reporting as fake news. Bank of America, Merrill Lynch was among the few skeptics, questioning Wirecard's positioning and raising concerns about financial controls. The final unraveling took days. KPMG's special audit, commissioned by Wirecard itself, could not verify the majority of profits from 2016 through 2018. The auditors could not confirm that the third-party cash existed. In June 2020, Wirecard admitted that 1.9 billion euros was missing. The company filed for insolvency on June 25th. CEO Markus Braun was arrested. COO Jan Marsalek fled to Belarus and remains a fugitive on Europol's most wanted list. The aftermath reshaped German financial regulation. BaFin's president and deputy were forced out in early 2021. Germany severed ties with its accounting watchdog, a quasi-official body that had only 15 employees and an annual budget of 6 million euros. The European Commission investigated whether BaFin broke EU rules. Singapore eventually convicted several individuals connected to the fraud, including executives who received prison sentences in 2023 and 2025. The mechanism here is not complicated. A regulator's jurisdiction determined its behavior. BaFin could not investigate Wirecard's payment processing business, so it treated criticism of that business as the threat. Short sellers and journalists became the targets because they were the only actors BaFin had tools to pursue. The company exploited this gap for years, adding revenue through acquisitions that masked organic growth problems, routing profits through unverifiable third parties, and counting cash it may never have held. EY has faced lawsuits from investors including SoftBank. As of this document, the consequences for the auditor remain unresolved. The structural gap that allowed Wirecard to operate, a payment processor regulated only at its banking subsidiary, has been partially addressed. But the broader lesson is simpler. Regulatory authority shapes regulatory action. When a watchdog cannot investigate the actual business, it investigates whatever falls within its reach. Thanks for watching. If this was useful, hit subscribe and turn on notifications. Sources for everything you just heard are in the description.